If you're looking for a way to truly live off of passive income and dividends, then this is the video for you. There's 3 newer ETFs taking the market by storm, and so I did the research for you to give you a better understanding of them all. This new Warren Buffett ETF is very exciting because Berkshire Hathaway is one of my favorite stocks and has been beating the S&P 500 for quite some time. But the only downside about Berkshire Hathaway is that it doesn't have a dividend. Well, now this new ETF has been hatched and it uses the companies that Berkshire is already invested in, and it's giving out a monthly dividend, and its dividend yield is near 15%. To put this into perspective, most dividend ETFs and even dividend stocks give you a dividend yield somewhere between 2% and 5%. Let's say you need something like $60,000 per year as far as living expenses, so you'd need $60,000 per year in dividends. In order to build to that passive income of $60K with a 4% dividend yield, you'd need $1.5 million invested. On the flip side, let's say that you invested in something that gives you a sustainable 15% dividend yield every year. To receive $60,000 in passive income from a 15% dividend yielding asset, you'd only need to have $400,000 invested. That's a major difference. That means many of you are much closer to being able to possibly retire or cut back on some hours and enjoy life more by investing in funds that have a higher yield. There are pros and there are definitely cons, so understanding these types of funds is going to be so important for your investing portfolio. So I'm going to go over the pros and cons of SPYI, QQQI, and OMAH. And then I'm going to compare all 3 together so that you can make a well-informed decision for your portfolio. My name is Nolan Govea. My students call me Professor G, and I made this channel to make investing simplified. The first one is called SPYI, and it has underlying assets tracking the S&P 500. The NEOS S&P 500 High Income ETF SPYI is designed to provide investors with enhanced income by combining traditional S&P 500 exposure with covered call options. So first, a couple pros of SPYI. And number 1 is that monthly dividend income. SPYI offers an impressive annualized distribution yield of approximately 12.2%. This income is generated through dividends from the S&P 500 and premiums from selling covered call options. The second pro would be tax efficiency, and this one is huge, especially if you're investing in these accounts in a taxable brokerage. The fund's use of S&P 500 index options qualifies for favorable tax treatment under IRS Section 1256, with gains taxed at 60% long-term and 40% short-term capital gains. Additionally, a significant portion of SPYI's distributions is classified as return of capital, or ROC, potentially deferring tax liabilities for investors. That's why I really like SPYI and QQQI actually over JEPI or JEPQ, specifically for the taxes, specifically if you're investing in these in a taxable brokerage. The third pro is that diversified exposure. SPYI holds over 500 stocks, mirroring the S&P 500 index, providing broad market exposure and diversification across various sectors. And then of course there's a couple of cons. So the first con for SPYI is just overall limited capital appreciation. It's not going to grow as much as some of these other funds because it is giving out a good solid amount of that cash flow. The covered call strategy can cap potential gains. For instance, in 2023, SPYI achieved a total return of 18.1%, underperforming the S&P 500's 26.3% return. Second con is definitely that higher expense ratio. SPYI has an expense ratio of 0.68%. And that third con is just that it's a complex strategy. The use of options and the classification of distributions add complexity. Investors need to understand these mechanisms and their implications, especially concerning taxes and potential impacts on the fund's net asset value. SPYI is tailored for investors seeking high monthly income with some exposure to the S&P 500's performance. Its strategy is particularly appealing in flat or moderately rising markets. However, the trade-offs include capped upside potential, higher fees, and added complexity. Now the next ETF actually has more room to grow as far as capital appreciation and even has a higher dividend yield overall. But first, thank you to investing.com for sponsoring this video. I personally like to use investing.com for my research, and specifically I use the Investing Pro, which uses AI to show some strategies that are outsmarting the market. During this volatile market in 2025, one of the most important things that you could be doing is doing heavy research. What I love most about ProPicks is that it uses artificial intelligence to analyze the market and gives you a list of the top investment opportunities. Instead of spending hours researching stocks, I can now check their picks and make informed decisions in minutes, and that's huge for my busy schedule. As an Investing Pro member, you don't only get access to ProPicks, but a whole suite of other powerful tools. One of my favorite things on this entire site is the Pro Research tab. When you look up a company stock, this is where you'll take your investing game to a whole new level, as you can learn anything and everything about a certain company stock. From things like the company financial health, to the valuation and analyst projections, to even seeing how the company makes money with all their financial statements easy to read right here. The best part? I managed to get you all the best discount. With my code, you always get 15% off an Investing Pro subscription. Click the link in my description to subscribe and start using ProPicks today. This offer is only available for a limited time, so don't miss out. So this next one is called QQQI, and it's the NEOS NASDAQ 100 High Income ETF, which has exposure to the NASDAQ 100 index with an option strategy aimed at generating high monthly income. So a couple of the pros for QQQI, and obviously number one is that high income and that it's paid out monthly. QQQI offers a substantial distribution yield with recent figures around 14.5%. This income is generated through dividends from the NASDAQ 100's constituents and premiums from selling call options. Second pro is tax efficiency, just like SPYI. This one's taxed like SPYI, which is 60% long-term and 40% short-term capital gains rate. Number three is that exposure to those leading tech companies. By tracking the NASDAQ 100, QQQI provides exposure to major tech firms like Apple, Microsoft, and Nvidia, offering potential for capital appreciation alongside income. The fourth pro here is active management. The fund's managers actively adjust the option strategy to respond to market conditions, aiming to optimize income generation and manage risk. Now, there are some cons of QQQI, and that first con is that there's a capped upside potential. The covered call strategy limits the fund's ability to fully participate in market rallies, as gains beyond the strike price of sold call options are forfeited. But if we look here, over the last year, QQQ has gone up 13.43%. And then if we look just at the price appreciation of QQQI, over the last year, it's actually down. It's negative 0.91%. Obviously, looking at those two side by side, you're gonna say, well, you lose a lot of capital appreciation with QQQI. But you have to remember that you have to factor in its dividend, and that high dividend at that, when you're looking at the total return. So when we look at the total return of QQQI, over the last year, it's actually up 13.8%, which is actually even higher than QQQ. So that's kind of interesting. Now, the second con on this list is the fact that it does have a higher expense ratio. It has an expense ratio of 0.68%, which is just like SPYI. Number three, and this one's a big one for me, and this is a limited track record. QQQI has a relatively short performance history because it was launched in January of 2024, making it harder to assess long-term effectiveness. I much rather consider ETFs and funds that have been around for quite some time before I try to put any substantial amount of my portfolio into it. And so since this has only been around for about a year, and that other one had only been around for a couple of years, it's definitely something that I'm keeping in mind, and I'm definitely not suggesting that you put a large portion of your portfolio into anything that's untested. The thing that does give me some pause there, though, is the fact that it's tracking an index that has been around forever. And so you can look at what happened during the 2008 drop and what happened in the 1999 drop and during COVID, and you can see how the index itself has come right back. So that gives me a little bit of peace of mind there. QQQI may appeal to investors seeking high monthly income with exposure to leading tech companies. However, the trade-offs include capped upside potential, higher fees, and added complexity. So now this last ETF, I'm going to explain the pros and cons, and then I'm going to show them all side by side so you can get a better picture and make a good decision for your portfolio. This next one I've been getting so many questions on, and the more that I look at it, the more it looks very appealing. The VistaShares Target 15 Berkshire Select Income ETF, OMAH, is an actively managed ETF that seeks to provide high monthly income by investing in a portfolio of equity securities based on the sole active Vista Shares Berkshire Select Index and implementing a data-driven options investment strategy. Some pros of OMAH, we have to start with the same pros that I've been telling you about the other ones, and that's that high monthly income. OMAH aims for an annual income target of 15% distributed monthly. This is achieved through dividends from its equity holdings and premiums from selling call options. Number two, one of the biggest things here for me as far as pro is the exposure to Berkshire holdings. The fund's equity portfolio generally mirrors the 20 largest holdings of Berkshire Hathaway, providing investors with exposure to companies selected by Warren Buffett. Number three is the professional options management. OMAH leverages the experience and rigorous research process of the Vista Shares team in managing options-based income strategies. Now, there are some cons of OMAH, and of course the first one is that pretty high fee of 0.95%. Number two would be the limited capital appreciation. The covered call strategy employed by OMAH can cap potential gains as it involves selling call options that may limit upside participation in strong bull markets. And number three of cons on this list is the concentration risks. By focusing on the top holdings of Berkshire Hathaway, OMAH may have less diversification compared to broader market ETFs, potentially increasing sector or company-specific risks. And actually one more, number four, is that limited track record. It's only been around since 2024, which always gives me some pause. Like I said before, I want to see how a fund does in good markets and in bad markets to see how it reacts. OMAH may appeal to investors seeking high monthly income and exposure to Berkshire Hathaway's top holdings. However, the trade-offs include a higher expense ratio, potential limitations on capital appreciation due to the covered call strategy, and concentration risk. So now you might ask, which is the best one? Which one should I actually invest in within my portfolio? Well, you need to keep in mind your investing goals, your risk tolerance, and probably most importantly, your income needs. I'm going to show you a quick side-by-side comparison so that it helps you out so that you can actually see how they differ compared to each other. And then after this one, I'll give you which one I think might be best for you. So looking at this quick summary table here, you can see the index exposure between the three, like I talked about from before. You can obviously see that the income yield is high for all three, but OMAH takes the cake there. They all have a monthly dividend, which is awesome. The expense ratio is definitely highest with OMAH, but since the income potential is higher too, you have to keep that in mind. The highest capital appreciation potential would be QQQI. Something to keep in mind is that there's definitely better tax efficiency at this point with SPYI and QQQI, but we'll see, especially as time goes, what type of optimization OMAH has. SPYI takes the cake as far as being the most diversified, and then it's also the one that's been around the longest, but they've all been around relatively short. So let me tell you which one's the best ETF based on your goals. If your goal is high monthly income, the winner would be OMAH. It has a 15% target, followed by QQQI at 14.5%, then SPYI at 12.2%. The caveat here, though, is that OMAH is newer and more concentrated. The income sustainability is unproven long term. If you want balanced growth and income, the winner here would be SPYI. The reason is that the broad S&P 500 exposure is less tech-heavy, lower volatility versus QQQI, and it has a steady income. But if you're bullish on tech and you also want to have that high yield, then the winner would be QQQI. So as far as the final verdict, the best for conservative income with diversification would be SPYI. The best for aggressive income plus tech exposure would be QQQI. And then the best for high income niche strategy would be OMAH, but be cautious due to its youth and concentration. I'd love to know which one you think is the best, so comment down below if you're investing in either one of these. And go ahead and watch either of these videos to keep you going strong in your investing journey. Remember to keep investing simplified.